All right, let's talk about investing. But we're not just going to talk about it. We're going to build a blueprint for it. We're going to break down the actual building blocks of wealth, piece by piece, so you can see how smart money really works.
So let's just start with the biggest question of all, right? When you get rid of all the hype, all the noise you see online, where do the pros, the people who manage serious wealth for a living, where do they actually put their money?
The answer might actually surprise you. It's not about some secret stock tip or just getting lucky. The real secret is structure. It's all about building a solid, well-thought-out portfolio with a clear plan. Think of it like an architect designing a skyscraper. And any strong building has to start with a powerful foundation. For our investment blueprint, that foundation is what we call the core. This is the engine that's really designed to drive your long-term growth. And that engine is equity, or what most of us just call stocks. Now, this is so important to understand. Buying a stock isn't like placing a bet at a casino. You are literally buying a small piece of a real business. You become a part owner. When the company succeeds, you succeed right along with it. I love this slide because you can kind of think of these different stocks as players on a sports team. You've got your blue chips. Those are your reliable veteran players who bring stability. Then you have your growth stocks. They're the speedy strikers trying to score big, fast goals. Dividend stocks are like your steady midfielders, consistently generating income. And then you have small caps. They're your high-risk, high-reward rookies who could have absolutely explosive potential. See, each one has a specific job to do. So why is equity the core engine? Well, it all comes down to this number, 10 to 12%. Over the long haul, that's the historical average annual return of global stock markets. It is by far the most powerful tool we have for beating inflation and building real wealth over time. But look, what if you don't have the time or maybe the confidence to pick individual companies? That's totally normal, and there's a simple solution for that. That's where funds come into the picture. So things like mutual funds or ETFs, you can think of them as baskets of investments. You just buy one share of the fund, and boom, you instantly own a tiny piece of dozens or even hundreds of different companies. They're amazing for getting diversified right away, for outsourcing all that research, and for easily investing in markets all over the world. Okay, so we've built our growth engine. It's humming along. But a good blueprint isn't all about offense, right? You need a defense system. These are the assets that protect your foundation, your stabilizers. And this right here perfectly illustrates the difference. With stocks, you're an owner. With bonds, you're a lender. It's that simple. You're lending your money to a government or a big company, and in return, they promise to pay you a fixed, predictable interest rate. It's not about explosive growth. It's all about stability. And to put a real number on that, imagine you buy a bond that pays 7%. You are guaranteed that income year after year until the bond matures. It's a predictable stream of cash that adds a really important layer of certainty to your whole portfolio. This is probably the best analogy for what bonds do. When the stock market gets choppy and starts bouncing all over the place, bonds are there to smooth out the ride for you. They are the shock absorbers that protect you from the biggest bumps in the road. Now, the other key defensive player here is gold. And let's be really clear about this. You don't buy gold hoping it's going to make you rich. You buy gold as an insurance policy. Its number one job is protection. And what does it protect you from? Well, it's historically been a hedge against rising inflation, a safe place to be during a major crisis, and a shield if a country's currency starts losing its value. Basically, when other systems start to feel shaky, investors have turned to gold for security for centuries. Okay, now we're going to move to the very top of our pyramid, the satellites. These are your higher risk, more specialized assets. They're not the core of your portfolio, but a small, careful allocation can give you a bit of a speculative edge. Real estate is a classic example. But let's be real. Buying a physical property is expensive, it can be really hard to sell quickly, and it comes with a ton of maintenance. That's why a lot of investors now use what are called REITs. They let you invest in a whole portfolio of properties just by buying it like a stock. It's easy to sell, professionally managed, and you can get started with very little money. And of course, we have to talk about the newest satellite on the block, crypto. This is a brand new digital asset class built on some really fascinating ideas like decentralization and a provably limited supply. It's incredibly exciting for sure, but it also comes with massive risks. And honestly, this slide says it all. When professionals advise their clients about crypto, they almost always recommend keeping it to a tiny slice of the pie. We're talking no more than 1 to 5% of the whole portfolio. Why? The volatility is just way too extreme for it to be a core part of your wealth engine. And finally, you have alternatives like fine art, rare collectibles, or private equity. Look, these are highly specialized, have super high barriers to entry, and are generally just for the wealthiest, most sophisticated investors. For most of us, they just stay on the watch list.
So we've built our pyramid, right? We have a core engine for growth, stabilizers for defense, and satellites for a little extra edge. But what's the one rule that holds this entire blueprint together?
This right here is probably the single most important takeaway from everything we've talked about. What is the one principle that truly separates amateur investors from the pros? Here it is. This is the golden rule. You never, ever concentrate all your risk in one spot. You spread it out across different companies, different industries, different countries, and different asset classes. You diversify. Always. There are absolutely no exceptions to this rule. And that really just brings us to our final thought. As you look at your own investments, I want you to ask yourself this question. Is your wealth being built according to a deliberate, thoughtful blueprint, or is it just a random pile of bricks you've collected along the way? The answer to that question, well, it makes all the difference in the world.